Welcome to episode 3 now of Mahmoud Zarabi's real estate podcast. We hope you've been enjoying it. Listen to them. We have some, guests coming up in the near future, which we think you'll love. And in this week's episode, we will be focusing on industrial real estate. Industrial is a specialty of Mahmoud's. He's been focusing on it for many years now. He's sold many units and projects, and he advises and consults builders on what to build, where to build, how to build across the Greater Toronto area. Recently, Mahmoud is working with a secret project for now, where Mahmoud's doing a lot of work, preparing, researching, surveying in the Greater Toronto area, and the industrial real estate in the Greater Toronto area. So Mahmoud has uniquely a lot more knowledge now about the industrial real estate. So the idea today is to go through it. What's happening in the industrial real estate market? Kind of why is it happening? What's the near future looking like? Should you buy? Should you sell? Should you invest? These are the things that we want to be discussing with Mahmoud, hopefully. So Mahmoud, how are you doing?
Thank you so much. I'm doing well, thanks. How are you doing?
Yeah, not bad at all. Just a little exhausted with everything going on at the moment, but that's totally fine. So take me from the top, Mahmoud. Like big picture, 2024. What's happening in the Greater Toronto area industrial real estate market?
Well, first of all, let me start off by saying that the industrial asset class is a class that no one predicted how it will go over this past 10 years. It has been one of the most surprising asset class in not only in commercial, but in real estate in general. And the impact of it sort of across the board in North America. Right now, where we stand, how about we do this? Let's take a look at the numbers where we stand, and then we can discuss what's been going on in industrial market space. And then we can touch on quite a few other items as well.
Nice.
Okay, so let me share my screen with you, Sarmat. So that way I can illustrate this much better. Let's start with what's the average sales price in the Greater Toronto area for industrial properties. And I'm taking a look at the graph over here, which is that of 5,000 square feet and less, but we can extrapolate this for higher square footages as well. There is some level of discrepancy, but for the sake of time, we're just going to use this as a reference point. So here we have the graph at the end of at the end of 2023, basically, we were sitting at around $500 a square foot in average price per square feet for industrial properties in the Greater Toronto area. Okay, so this is in terms of the sale price. Now, in regards to the rental prices, we're sitting at over $20 a square feet in net rent.
A record high.
Pretty much, that's it. And sort of the trend line and what's expected is for this to continue to grow, much the same way that it has grown, both in terms of rentals as well as in terms of price per square feet for sale prices, has grown exponentially and expected to grow in a very similar fashion. Let me share one other thing with you. Let's share this graph. Let's take a look at this. So this is the sales volume. So how much volume has been consumed and what is the sale price per square feet? So right now, again, we're looking at just hovering around $500 a square foot for sale prices. And as you can see, one thing to notice here is that the consumption has decreased for the last year or two. This is consistent with the interest rates going high. And remember that in commercial, when interest rates, in real estate, when interest rates go high, especially in commercial, it affects it more because the interest rates in commercial is higher than residential side. So the impact of it has definitely been felt in all over the real estate market, but specifically in the industrial as well. So the consumption has been low, because of the high interest rates. And as a result, the price has come down because of that phenomenon over the last year or so. Now, with the upcoming interest rate cuts, we're expecting that there is going to be a lot of buyers sitting on the sideline, and they're going to be consuming this, and the prices should go back up in the next year to 2 years.
So is it fair to say, in terms of sales volume, this is what, the lowest since like the quarter of COVID hit, correct?
That is correct, yes. So this is when the COVID era was. We're probably sitting just about that in terms of consumption. Let me share another graph with you. This is where the vacancy rate is. So right now we're still sitting, though, even though the consumption has been lower, we're still sitting at about 1% or hovering just around 1% vacancy rate. And for those of you who don't know, vacancy rate basically means how much available property is in the marketplace that is vacant at one given time. So this is a summation of all the square footage in the Greater Toronto area, how much of it is already consumed, meaning it's occupied by either tenants or owners themselves, and then how much of it is vacant at one given time where it's available for someone to either lease or purchase. So as you can see, the vacancy rate is still pretty low.
So the 2025, we're expecting a huge amount of supply to come into the market, correct?
That's correct, yeah.
And like 2026 and onwards, if I'm not mistaken, industrial real estate is quicker to build. So it doesn't necessarily mean that there's going to be less supply 27, 28, right? It could mean that they have projects being approved in the next year that will come online in 2 years from now.
That's correct. So this, the source of this particular graph, it anticipates actually the projects that are anticipated to come into the market, and hence it utilizes that particular forecast. But of course, with any particular forecast, this is just a rough forecast, and I wouldn't count too much on this at the moment, I'll be honest with you. Because yes, there could be other projects that could come into the market, and that could be reflected. The other ability that this graph doesn't have, unfortunately, is it doesn't have the ability to see how many buyers are actually sitting on the sidelines. It has no knowledge of that particular piece of information. And that knowledge comes from us because we are on the ground. We know we've dealt with hundreds of clients throughout last year that just purely were not able to make a purchasing decision just because they weren't able to qualify at these rates. So now, as soon as the rates comes down, guess what they're going to do? They're going to come back into the market. So that level of data, unfortunately, is not available to this particular source in terms of the buyer data. But in terms of constructions and products and all that, this source has it, and it illustrates and shows it on this particular graph. Here's another graph which sort of showcases the market rent. Here they're forecasting it right now to be around $23 or so. Now, again, these are rough numbers, both in this forecast as well as in the graphs that we showed. But what is significant to know, or what is important to know, is that we're sitting well over $20 a square foot in net rent right now. Can you believe it, Sarmad? Remember, like a few years ago when we were talking about, $6 and $7 and $8 a square feet of net rent?
I remember the project we worked in 2017 or 18.
Yeah.
It was that. It was sub 10. We were projecting 12, I think, back then, if I'm not mistaken.
Yep.
And then we were telling people, like, invest in this, it's going to go up. And people were like, yeah, by how much? Well, look at us now, huh?
Yeah. Look, here's the 2017, right? This is the average rent around that particular time, 2017. And this project was supposed to complete around 2020. So it would have been around $11. This is the actual figures. We were saying it will be around 10 to 12. So we landed around $11. But this is like a big, it required those investors, they made a lot of money. However, these investors needed to be visionaries. Like they needed to see our vision as well. Because when we were talking to them, let's say in 2017, and the rent was around $7, right? $7, $8, something like that. Like quarter two, quarter three was around $8, right? So that's where we were. And throughout the last, I don't know, 5-7 years, all the rise that they have seen has been around $6, $6, and now it's like $7. So to tell them that the rent is going to be $11 to $12, $10 to $12 in the next few years, for them, it was just inconceivable. So they were like, how is it going to grow? How are you going to guarantee something which has never happened in this particular, like throughout the history of industrial real estate in the Greater Toronto area? But we did come out true. So by the time this, we were in 2020, look, we closed that particular project in the beginning of the third quarter. So we were around $11 of rent. So about $4 of rent increase over those next 2 years. How we were able to do that? It has its reasoning. We'll certainly delve into this because that will give us the ability to forecast into the future now as well. But yes, it was a tough take for a lot of people. We still have some of these. Look, I have the ROI calculators. Look at that. Look at that. I have the ROI calculators at those particular times. Right here.
$270 per square foot. Give me 10 of those, man.
Exactly. Look, this was look at our scenarios, okay? So we were like, hey, let's say even if you were to sell these. So this was immediate equity based on current new building comparables, and we were looking at returns of 131%, 46%. In a better world, we were looking at 229% sort of profit on their investments that they were doing. And if I'm not mistaken, so this would have, we ended up somewhere over here. We ended up around here. So they made around 131%. Okay? They made around 131% sort of profit in those particular scenarios. So let's talk about this sale price. Actually, let me share with you an analogy first. At the same time, I don't know if you remember, Sarmad, in 2018 it was, okay? There was a client that was selling their industrial property, about 17,000 square feet in the North York area. They were selling it for $4.6 million. Do you remember that? This was around.
Was it the guy in the States?
No. This was in auto parts business in North York area.
Oh yes. Yes, him and his sons.
Yeah. So they were selling their shop, 17,000 square feet of warehouse in North York area for $4.6 million at that time. So this is 2018, if I'm not mistaken, something like that, or 2019, let's say. They had purchased this back in 2008 for like $800,000. So they were roughly approximately, give or take, making about $3.5 to $4 million on a piece of industrial property that they probably didn't make that much profit from their business. So that is which is such a phenomenon that no one predicted. No one anticipated it. This was going under the radar of everyone. Because remember, 2010, 2012, this was the hottest market for a residential marketplace, right? Retails was going crazy in commercial. Office was a little bit on the decline. Industrial, nowhere, nothing to be seen. No one cared about about industrial properties. There was no builders out there. It wasn't even worth for them to build anything. Everything was residential. Take land, convert it. Take commercial land, convert it into residential, rezone it, build a condo on it, build houses on it, and that's how it was. And to a certain extent, that has contributed actually to the rise of prices in industrial properties because there was no land available to build on it. But first, let's take a look at what's happened. So if you look at, let's say 10 years ago, so at 2013, in terms of prices, average prices, we were looking at just $150 approximately per square foot. 2013, so about 10 years ago, we're looking at $150 approximately per square feet, whereas now we're looking at about almost $500 a square foot. Basically, give or take around $500 a square feet. How much is it? That's about over 320% increase in terms of
70%.
370%. There you go. In terms of prices. If you were to average that out over 10 years, how much is that? That's about what, 10%, 13-14% growth every year?
37% a year.
No, but that's without taking that's just dividing it, so it compounds. So next year it becomes from 150 to 180. It compounds. So if you average it that way out, it's about 15%, if I'm not mistaken. So look at rentals. This is funny, by the way. Let's start with an analogy with this one as well. Make it equal. So this past week, we were sitting down with a client that wants to open up recreational facility anywhere in the GTA. They were looking for 10 to 12,000 square feet of space. And they specifically wanted to work on badminton recreational facility. But irregardless of that fact, one thing that we do when we deal with our clients, by the way, is we are their partners in their business, for lack of better words, without looking at any of their gains, without taking any of their gains. But we're truly their partners. So our initial meeting with any of our clients is we sit down and we even analyze your business with you, especially if it's a new business. And we look at what your needs is for your business, and we help you to find the right product that will not only meet your needs now, but also into the future. But having said that, for these clients, I really wanted to make sure, because it's for a brand new business, if they knew exactly what they were doing and that they know what they're getting themselves into. So they had their business plan and everything ready and prepared. And one piece of information that they needed from us while we were discussing it was they wanted to know how much they could anticipate for rent, lease prices. How much would they be paying on a monthly basis? So we said, approximately you'll be looking at, let's say for 10,000 square feet of space, you'll be looking at about $25,000 of rent just in lease rents, based on like $20 of, we anticipate, let's say $20 per square feet. So they were like, okay, well and then we calculated what their potential revenue is going to be. And that was coming about just shy of, let's say 40,000. So 37, 38,000, something like that, based on the anticipated sort of capacity that they were looking at over the next few months. So their main question was, this doesn't leave them much range of gross profits. It's only like $12,000 to be able to spend on other areas of this business. And I was asking them, are you able to charge more? What can you do to increase your sales revenue and whatnot in order to survive in this business? And then they asked me a question. They said, well, here's this particular company. How are they able to survive? And their rates, they're charging, we wanted to charge $30, they're charging $25. They're charging $20 of rental prices per hour. So I was like, how long has this business been there? And they're like, they've been there for at least 5 to 10 years. I said, well, that's your answer. Because right now you're looking at $20. 10 years ago, they were looking at $5, $6 of rent. Look at that. They're paying $6 of rent. They're paying less than 1/3 of the rental prices that you'll be paying. So they might be paying $7,000-8,000 of rent, $9,000 of $10,000 of rent, whereas you're paying $25,000 of rent.
Why doesn't the landlord for those properties just jack up the rent?
It's because it's contractual. So if you've contracted for 10 years,
They said what a 10 year. So okay,
It could
but
be
like most of them are 3 to 5 years.
yeah, generally it's 5 years. But if you are, there are businesses that sign contracts for 10 years, 15 years. But now I don't know the specifics of how long that contract has lasted and what their renewals was. But the mere fact, that it has been at least 10 years, look at the differences. 10 years ago, they could have started their rent at $6. And that's why I was like, maybe they're paying $10,000 now. Maybe they're paying $11,000. Maybe they're paying $12,000 now. Because what they had to do was, okay, from $6, they put, okay, it will go to $6.25. It will go to $6.50. It will go to $7 with the rent escalation. And they set it out for 10 years, for example. So they're very well protected. And then I was telling them, I said, you know what a good business opportunity is? Because I took a look for them when their contractual period is going to come to an end and when their zoning review is going to happen. And it was going to happen in the next year or two. I think by 2024 or 2025. So I was like, two things is going to happen. Either they're not going to get approved, get continual approval for their zoning, or they are potentially not going to be able to survive at their current rates because of the renewal rates that they'll have to do. Let's say if they have to do it at over $20. So I said, just go get a facility right beside them, survive for a year, and then you're going to steal all of their clients to come to you. That's an interesting business concept and take that you can do. So yeah, just take a facility with them, beside them. You'll struggle for a year. Thereafterwards, then you're gonna get all of their clients.
They're gonna be surprised.
Yeah.
Maybe you can even buy out the business if they're not anticipating or expecting such a high increase in costs.
It's possible, but then you need to have capital, and you have to. They will, the businesses are valued at based on what their current and just near future evaluations is, and you're gonna have to buy it out. So these guys, you can open up. The demand in recreation in the GTA is so high that you can open up a recreational facility anywhere and it will get filled up over the next 3 to 6 months.
So Mahmoud, like what drove this growth in prices and leases in industrial real estate, and are those same fundamentals still at play today?
That is an excellent question.
Thank you, Mahmoud.
This is a very important question to answer, especially because right now we care about what's going to happen into the near future. Like listeners, they don't care about 10 years ago. We wish we could be on, go back 10 years ago and, invest. But listeners they probably care about something right now, what's happening now and what's going to happen in the near future, so that they could take measures and protect their investments now. However, in order to be able to do that forecast for the future, we do have to understand the fundamentals of what's at play in industrial real estate. What's happened over the past 10 years that we've seen this growth, that you've asked me that question. And what are the fundamentals as to what is driving this growth that we're seeing. And this will give us the ability now to extrapolate and forecast the future to a certain extent. So I'm hoping that I can sort of get this across to all of my listeners. Well, there's a few fundamental items that has occurred simultaneously over the past 10 years. But let's just start off with purely industrial and say, what's driving the demand for this? Well, first of all, if you notice over the past 10 years or so, in the 2010s and thereafterwards, the e-commerce industry has taken an exponential rise. So you have Amazon, you have Walmarts, and you have all sorts of e-commerce companies coming in at play, and people ordering all of their products almost, online. I personally barely have time to go to the mall. I actually visited the mall, by the way, after maybe 2-3 years with my wife, and I was like, hey, actually, this was a nice date. It felt like a date environment. Like, hey, this is so cool. I don't do that. My mom, who is well into her high 60s, maybe even low 70s, and she's not tech savvy whatsoever. And during COVID time, what happened was she was like, we were seeing a lot of these retail stores close down. Everything is closing down. So one of my other family members was like, well, where are we going to buy all of our products from? And then she's like, we'll just buy it online. So the rise of e-commerce certainly plays a very big role in this particular regards, because what does an e-commerce need? An e-commerce, all they require is, they don't need a retail space, they don't need an office space, all they need is a warehouse to store the products, and therefore afterwards just ship the products out to the clients. So this increases the demand on warehousing. And this was not anticipated, before 2010s. There was, the trend was going there, but people were still not accustomed to it. Now, this leads to the second element of, which is perhaps even more fundamental than e-commerce, and that was this e-commerce business gave rise to logistic companies, even more so, becoming the main players in industrial real estate space. And these logistic companies built a network of distribution hubs throughout the city in order to be able to meet the demands of their clients, and let's say e-commerce clients, but also B2B clients. For logistic companies, these are companies where, let's say you order something, for simple example, you order something from Amazon. Now, think about this. I order a $10 product from Amazon, and it gets to my house the next day it gets to my house the next day. Now, how much did it cost them? It's a $10 product. How much do you think, and this is pretty big, it's a decent weight size and it's pretty big. It comes into a big package. So how much do you think it cost them to ship that product here to me? Did they spend $5 on it? Did they spend $10 on it? The product was $10. So it doesn't make sense that they spent $10 on it. Right? So it's puzzling to me, even when you think about it right now. How is that possible? That I have Amazon, its warehouses in Brampton, and then they ship this product to me, and there's millions of orders that gets shipped out, on daily, weekly, and monthly basis. And it's going to individual houses. This is the last mile distribution. So what these logistic companies realized was that the cost of getting the product to a customer is very high. The cost, and what they realized was, I own a product, industrial product. Let's say this is 2010 or 2012 for our simple perspectives. And let's say here 2012, we're looking at around $150 of price per square feet. So what they realized was, if I were to take, let's say, a product from Amazon in Brampton and ship it, let's say, to Richmond Hill area, it's going to cost me 10 times the amount of cost of me actually owning the warehouse in Brampton. So when I'm shipping something out, the cost of shipping accumulated is 10 times more than if I were to have a warehouse near Mahmoud's house. Yeah. So they're like, actually, this doesn't make sense. Why are we wasting our money on gas and distributing this last mile distribution? Okay, so why don't we do this? What they started doing was in urban city centers areas, they have one big warehouse, let's say 200, 300, 400, $500,000, 500,000 square feet warehouse outside of the city. But that is useless to ship products out from there across GTA because it's going to cost a lot. Why don't I go ahead and I buy 20,000 square feet of space near Mahmoud's house? I'll buy it in this city, I'll buy it in this community, I'll buy it in there, all across the city. So everything between 20,000 to 50,000 square feet of space, all of a sudden started getting gobbling up. And you're looking at somewhere around 2014, 2015 when this started happening, and you're seeing all of this particular rise in price per square feet because everyone started buying. These logistic companies, they needed to increase their distribution network as soon as possible for other reasons as well, which I'll get into. But these logistic companies started gobbling up all of these warehouses because they're like, I can own an asset. I'm not wasting the money. It costs me less to own a warehouse close to Mahmoud's house rather than me shipping something out from Brampton. Makes perfect logical sense. Prices are ever so cheap, so let's just start buying. And this increase in demand over the past 10 years has really shifted the industrial marketplace. So e-commerce, then we had logistic companies, and then even, let's say this, do you see this 2021? Do you see this big increase in pricing that occurred in 2021? Generally across the real estate market, these prices did occur. But one of the reasons was also when we had COVID, what happened? We had our supply chains get affected. We didn't have any manufactured items, and we were really struggling because prior to COVID, what everyone used was a just-in-time system, JIT system. If I'm a manufacturer, if I were to store my items in my warehouse, I'm going to need a lot of product, and it's going to cost me a lot. So the ideal solution was I get my product, I manufacture it, I ship it out, just-in-time system. This is just a simple example of a GIT system. Now, all of a sudden, supply chain is blocked, and the manufacturing process stopped. We had supply chain issues and whatnot. So what these companies were now in trouble. So now all of a sudden, a lot of these companies and manufacturers realized is that they're in a lot of risk with a pure just-in-time system. They need some level of buffer that in the future, if there is going to be a supply chain issue of any particular sorts, that they have some level of onshore warehousing or products available. So what they started doing, sort of the trend that occurred, was we had onshoring of supply chains and of products. Companies started buying warehouses in key demographic areas and storing a certain level of products so that we don't run into these issues into the future. And even manufacturing, now we're talking about even bringing a certain level of manufacturing into Canada from overseas in order to ensure that we meet the minimum requirements for Canadians. So all of these, there's quite a lot of other fundamentals as well which has increased the demand, but these are some of the major ones that has occurred over the past 10 years, which has really driven the industrial market prices as well as rents accordingly.
Nice. Something something else, which I'm not sure how much of an impact it's having, but I'm aware that the US is spending a lot of dollars, trillions of dollars for manufacturing in the US. Well, it's not for manufacturing in the US, but they specify that the parts have to be made in the US. So a lot of onboarding's happening. There's more manufacturing happening now in the US than for like 20, 30 years. And Canada and Mexico, because they have the free trade agreement with the US, they benefit from that. So I'm sure that also has an influence into space. Okay, like looking at now and in the future, like obviously from the charts, it doesn't seem like prices have stabilized, but like, is there a potential solution? What does the future kind of look like for this space? Can it be solved? Why not?
So that's an excellent question. So the solution, we have to look at the demand and the supply issue. So we talked about the demand. Let me delve into one other factor in terms of the demand, which I think is very important to this question about what's the solution for it. And is the demand going to ever remain so high? Because that's very important to understand before we can talk about the solution. We talked about e-commerce, logistic companies, onshoring, so on and so forth. This is what is the action that is happening on the ground. But fundamentally in the back end, what we have to understand is that there has been and is continuing a shift of human behavior that is driving this demand. Let me explain what I mean. 10 years ago, if I wanted to order something online, if you wanted to order something online, 10 years ago, Sarma, what would be your expectation? You order something, how long were you willing to wait for that product to come to you?
A few days.
A few days? You, I know, are very, very impatient. So for you, is a few days. For me, 10 years ago, if I ordered something online, 2 weeks, 3 weeks, no problem. Like that was my normal expectation. It will get to me in 2 to 3 weeks.
This is also a London-Toronto thing, by the way.
Oh, yes, true. 10 years ago, you were in London, so it's a different thing. Yeah, you're right. Yeah, in Canada, we were like, 2 weeks, 3 weeks, no worries, we'll get it. Now, what is my expectation? Or what is your expectation? You're in Canada too now. Today, if you were to order something, what's your expectation?
Next day.
Next day.
I sometimes don't even order if it's not next day.
Yeah. I don't. I never order. Me, when I go, let's say on Amazon, I always select the Prime button because I want my item next day. Minimum next day. But this expectation is driving even further. Like Amazon or Walmart is offering produce items for them to get it to you within the same day, 2 to 3 hours. So you order it, in the next 2 to 3 hours, those produce items will get to your house. So how are they able to do that? The only way that they can do that is if they have, the logistic companies need to have a strong distribution network and warehousing close to your property. That those produce items or the items that you ordered online has to be close to your house in order for them to instantaneously ship it out to your home. So this change in human behavior is not just limited to me doing an online purchase. It's throughout our psychology as a human being. So even videos that I watch before, no problem, half an hour video, no worries. 5 years ago, I watch a 5-minute video. Today, I don't have an attention span for 30 seconds even. If it's more than 10, 15 seconds, that's it, I'm moving on. Right? I watch 10, 15 seconds, that's it. So we are more so being aligned, and human behavior is changing for instant gratification. Now this is making the online commerce industries quite competitive. Meaning, in order for you to survive, your business to survive, I need to be able to meet that expectation, because I'm not ordering items from Amazon that's going to get to me in 2 days, let alone a week or 2 weeks. I'm looking for something tomorrow. That's it. And for it has to come to my place. Otherwise, I'm not ordering. So for businesses to remain relevant and to be competitive, they need to be able to ship their items to me immediately. And in the near future, even on the same day. So how is that possible? That's only possible if there is very strong logistic distribution network. So this trend of demand is going to continue, where any particular piece of available industrial property that becomes available in urban city centers. So this is areas where there is a lot of population in small compact areas. I need to have warehouses everywhere. So when warehouses become available, as a distribution network, as a logistic companies, I'm going to gobble it up and I'm going to buy it. The point being is that demand is going to continue because our human behavior is heading that way. And as long as that is heading in that direction, then that demand is going to continue. And that demand gets reflected on every person and entity that looks for an industrial warehouse. That could be for someone who's doing a mechanic shop. That could be for someone who is, woodworking, someone who is manufacturing. It impacts everyone in the industrial marketplace. So keeping this particular fact as an overall in mind, the demand is ever so going to continue. And even if you notice these price decreases that has occurred over the last few years, it has been because of the interest rates. We work with hundreds of clients at the moment that are just sitting on the sidelines waiting to get into the market as soon as the interest rate situation becomes better, which is anticipated to become better starting, let's say, this summer to next year to 2 years. The interest rate should be going down, a couple percent. And when that becomes more affordable, all of these buyers are going to come back into the market. So this is, from one side, a demand situation. The next question is, what about the supply? How come we're not able to meet the supply requirements, or we haven't been able to meet the supply requirements now? And are we able to meet the supply requirements in the near future? So first of all, like I mentioned earlier in this podcast, it did not make sense for the builders to build there was no incentive for them to build industrial properties, let's say from the 2000s to 2010s or mid 2010s. Primarily because, the cost of industrial properties was like $50 to maybe $100 a square foot during this particular period. The price of the industrial properties. Now, to construct it, how much the construction costs would have been? Probably a lot higher. There was no incentive, there was no profit for them to build it. On the other side, you had residential properties that was just completely booming. So what happened in the late 1990s, in the 2000s, and in the 2010s, a lot of commercial land that was available within the city centers and urban city areas was converted from commercial to residential. So they made skyscrapers on it, they made condos on it, they made low-rise home, single detached townhouses on it. Everything was converting to residential. And the most valuable piece of industrial property, remember, is within these urban city centers. So right now, practically within the GTA, there's very limited commercial land available for construction. So the supply, where is it going to come from? Now, the next question is, do the builders have the will to develop it now? Yes, they do. Because right now they're sitting at $500 a square foot in pricing. Construction costs are probably anywhere between, let's say, around $200. Land has gotten very increased, very expensive, by the way. So you're depending on where it is, but let's say in urban city centers, you're at least averaging at $3 million an acre, if not more. So, but are they still incentivized? Yes, because the trend is going to continue. Prices probably will average in the 600s in the next year or two. So they're still incentivized. So is there motivation? Yes. The problem is there's no land available to build. I can make something outside of the GT. I can go up north. I can go to Newmarket. I can go to Barrie. I can go to Caledon, and I can go outside. I can go to east to, I don't know, Whitby and Oshawa and beyond, or I can go west, in Hamilton and London. But that still doesn't solve my last mile distribution or for the immediate businesses that need to be within the city. And that's the problem, and that's the challenge. So the supply is very, very, very difficult to come by. Now, having said that, with what happened when this trend line was happening sometime in the 2018, 2019, 2020, sort of the builders did come across, a lot of builders did get incentivized. So they did buy land, and there is going to be quite a bit of supply coming into the market over the next couple of years, for sure. But is it enough to meet the demands? I don't think so. There's quite a bit of demand. Even like we noticed, the vacancy rates, it's still around 1%, even though there's supply coming into the market. So what is the solution to this problem? It has to be something extraordinary. It has to be something's got to give. So the question is the demand going to dry up? No. Can we bring in supply to help with the last mile distribution? No. So what could potentially be the solution? If we change the face of last mile distribution. That's like if there is a new type of technology that can help us. So for example, drone delivery. There's quite a few companies that are working on this regulation. If and when, I should rather say when, and I think it will happen, when the drone deliveries get their licensing and the capabilities, and where now the distribution, it used to take 3 hours to get from London to downtown Toronto, or 2 hours, and now it can happen in 20 minutes through drone delivery with minimal expenditures, then these distribution networks are no longer going to be that much relevant to that extent. But for that to happen, on a very minimum, you're looking at 5 to 10 years. Minimum 5. The technology exists right now. I'm invested in companies, drone delivery companies, by the way.
I was trying to say anything.
I am invested in the drone delivery companies because I do see that happening, because it's solving a very valuable problem that exists across the world and across North America. So it's the technology even exists. The main challenge, the problem is that of the licensing. Is the laws and whatnot, the aviation, how it's going to be handled, and the rules and policies. And it's being worked on. It's been worked on over the last 5 years. There's companies that have partnerships with Air Canada to make sure that these happens. Is it going to come in the next few years? Definitely no. Is it 5 to 10 years? Potentially. We are accelerating in terms of our technology and policy advancements. But once that happens, I think that will sort of take care of this issue. But for the foreseeable future, let's say the next 5 years, this trend, I believe, is going to continue.
Cool. So, Mahmoud, looking into 2024, now the next year, the next 2 years, what do you expect is going to happen, or what's the smart money on, so to speak?
First thing that I want to show you is, even though we're going towards a very exponential growth trend line, it's not straight. So this is the trend line. This is the actual values going up and down. So, 1 year there's a significant price increase that happens. So let's say, look, 2020, let's start with 2020, right? So right here. So you have significant price increase, then price decrease, price increase, decrease, up and down, up and down. Right now, because of what's happened over the last 2 to 3 years with the interest rates, this has put a downward pressure in terms of the buyer's capabilities to purchase industrial properties and for them to qualify financially. With the interest rates going down, this is going to give. And I anticipate a sharp increase in terms of the demand on industrial properties, and most likely that's going to be very quickly going to reflect on the pricing of industrial properties. So we're going to quickly come back to this trend line. Probably we're looking at, let's say, maybe by the end of this year. Again, this is just pure speculation. Don't take this as advice. I have to give disclaimers. Everyone's case is different, and we have to analyze it, and you have to be our client for us to give you advice. So don't take this. But our anticipation is that we're going to be far closer to this trend line, if not higher than this, coming by the end of this particular year. So we're looking at $550, $575 of average price per square feet, and this will continue over the next year or two because there's a lot of buyers waiting out there in the back and just looking to jump into the market. So the immediate right now, I think over the next couple of months, we're still going to see tightening. So they're still sitting on the sidelines. With industrial, I think we will definitely see increase as soon as the interest rates come down. Maybe another thing to keep an eye out on is you have, when the general real estate, if you notice, look, in 2021, we also had residential real estate go up. Okay, we had residential real estate go up sort of at the end of this particular quarter and in 2021. Okay, so industrial, in terms of trend line, if someone wants to use it as a trend line, lags the residential. So once the residential does well, next 2 quarters afterwards, industrial does quite well. So we're definitely going to see an immediate increase in terms of prices. So if you're an investor, this probably might be a good time if you're able to qualify. If you are an end user and you're leasing out properties, it might not be a bad idea to look in terms of securing something now, even if it is on the pre-construction world, by the way. In industrial, the good thing is the pre-construction pricing generally works in line with the resale values. So you're getting a superior product at resale prices, 20, 30-year-old building prices now, and it's going to be completing in a year to 2 years from now. So it's probably one of the best time to get into that market.
And then, like, in terms of beyond prices, right? What advice would you give to people looking to buy or sell industrial real estate in 2024, 2025?
That is an excellent question. Well, first of all, I just started off with saying sort of the demand, general demand is, first of all, in terms of new product rather than old product. Okay? Generally, they say that, consumers pay about 10 to 15% more for newer products as opposed to older products. But in industrial, I think that's even exaggerated even more. In the resale world, people are willing to pay 20% more, 30% more if it's a new product as opposed to older product. When it's built. So not in pre-construction world, but when it's built, because then they can tangibly see. And the reason for that, by the way, is sort of construction in industrial has happened, in the 1970s, in the 1980s, then very little in the 2000s, for example. Then in the 2014s and 15s and beyond is when we've seen some new industrial properties coming to the market. So when it's old, it's old. So in the resale, it's not like, oh, it's 7 years old, it's 8 years old, it's 10 years old. No, there has been significant gaps as to when these industrial properties across the GTA has been built. So a lot of these properties that are 20 years old, 30 years old, 40 years old, 50 years old, they have a lot of intrinsic problems. The roof is leaking, they're not well maintained, the property is in really bad shapes and condition. And if you're paying $500 a square foot for an old property, and then you have a new property, people are looking to avoid all those headaches and maintenance costs and just get into a new property. So if you have the ability to get into a new property, that's definitely of course, a lot of demand. If you're an end user, for obvious reasons, because it's new, you don't have to worry about maintenance and problems with the property. And if it is if you're an investor, sort of that's the higher the demand is in terms of newer properties. So that would be my first recommendation. Second recommendation is, again, industrial properties within urban city centers is key. So ideally within the GTA and specifically along the 401 corridors. So main problem with the industrial warehousing that it tries to resolve is shipment from one point to the other, taking in product from one point and distributing it out to another point. And that it happens across our major highways and primarily around the 401 line. So the closer you are to 401, the better in demand that product is going to be, and probably more expensive it's going to be, but that's where the most in demand happens. The further away you are from major highways, the less in demand it becomes. So try to stick to the 401 line as much as possible. And then you have the 400 line, which is not bad. 404 is pretty good as well. But mainly the 401 line is where you're looking for those. So now, and then the rest of it in terms of recommendations, it depends on the client, like what they're trying to do. Like, for example, investors, I'll give you another example. There's certain investors that we work with, that what we do is we go find for them industrial properties that have been converted to office. So there's their office properties, and because they're office, they're not as much in demand because they're in office. So generally there's a price difference of $50 to $70 or $80 per square feet versus if it was an industrial property. So we purchase those properties for those investors. They sort of knock down all the walls and offices, make it back into industrial, and then we put it back into the market for them. So that is a good opportunity that you could look at. Those are the main key things. And of course, other small little details, such as, of course, the higher the ceiling heights, the better it is. If it's beyond 24 feet high, then you can add a mezzanine onto that, extend it. That increases the price and the value that it brings to individuals. And then whether it's depending on the type of businesses and the amount of square footage that you're targeting, it could be a drive-in unit or it could be a loading dock unit. But if it becomes something of like 4,000 square feet, 5,000 square feet or more, it should have a loading dock and beyond.
Okay, so Mahmoud, in terms of, that's for the sellers. In terms of builders, if you're looking to buy land, build it, develop it, what advice would you give builders and developers of industrial real estate in the Greater Toronto Area today?
Oh, that's a very good question. There's no one right answer for all, but just stick to the fundamentals. So if you're a builder, first of all, you have to do an analysis of the land, where it's located, and what type of clientele that it can serve. And then according to that, then you build the features to it. So for example, let's say if you have, in an ideal world, again, because the most in demand is along the 401 line, the 404 line, the 400 lines, as close to the major city centers, if you can find a piece of land, and close to the major highways, the better it is. That means the demand on your property on that particular piece of industrial property is going to be high. Now, again, it depends on the portfolio. So if you're a builder that's going to be building $300,000 square feet property, you are targeting a different market segment. You're targeting the Amazon warehousing, at the distribution at the top level. So you're going to be looking for properties or land outside of the GTA because they're cheap. Land is cheap. You cannot make that distribution hub, let's say, in the heart of Mississauga, where land is going to be $3 million, $4 million an acre, as opposed to when you go out there, you're looking at, maybe $500 to $1 million at most. So, and if you go really out there, it's going to be even cheaper. So it depends on what your purpose is that you want to make it, and which type of market segment you're looking at. Once you figure out who the target market is, then you need to do an analysis about what is it specifically that they require. So are you building smaller units, 2,000, 4,000, 5,000 square feet units? Those are the targets. Are you targeting, logistical companies, 20,000 to 40,000 square feet units? Are you targeting manufacturing, 10 to 20? So then you build it according to their specifications.
Are you able to give advice that's not just broad and it depends on your situation? Just like, what are the trends, like something like that? Like, of course, it depends on your specifications of what you're trying to build.
That is an excellent question, Sarmad. However, in regards to sharing advice to builders about construction, there's a lot of industry secrets there, which I don't know if I'm at the liberty to disclose publicly. Hey, however, if you're a builder or a developer and you'd like to sort of us to discuss your particular situation, and here's the land, or here's the type of property that we want to make, or here's our objectives and goals, we'd be happy to sit down with you one-on-one and sort of give you advice accordingly. So if you are looking to make a 200,000 square feet outside of the GTA, it will have different configurations and different advice, versus if you are making a 30,000 square feet industrial property within urban city centers. And of course, based on your advice, based on your objectives, then we can give customized advice who your clientele target should be, what type of properties and configuration they're looking for, things of that nature. Now, general trends that I can share with you, though, like the higher the ceiling height, there's a sweet spot to it, depending. But the higher the ceiling height that the property has, the more sort of better it is for the end users, because they're able to stack high. Now, there is a sweet spot depending on your configuration. There could be wastage of space, like depending on the dimensions of the warehousing and the ability to use lift trucks and forklifts and whatnot. So ceiling heights is a very important consideration that you would need to give. The other consideration is the sizing of the warehousing. Right now, what's happened in the market is, a lot of these logistic companies have come and taken these warehouses. So where did these people that were occupying these warehouses, where did they go? They had to take other warehouses that were perhaps smaller in size. And a lot of these small businesses that are looking for 2,000, 3,000, 5,000 square feet of space, these are small businesses in Canada. Unfortunately, their warehouses are being taken over by these logistic companies, so they don't have any place to go. So they're quite an underserved community. So that could be an area that builders could look at, especially if your land that you're targeting or the land that you have is within the urban city centers. So they need a lot of help, and if you can sort of construct properties within the range of 1 to 5,000 square feet, I think that's very helpful for that area, and you will do well in that range. And then you could target logistic companies. So there's different logistical companies, different distribution networks, and where do they require it, that we can target a piece of land in terms of where they're going to anticipate, and we could sort of work with you with that land and build it towards their specifications, so a logistic company can come and take it over. So different advices for different builders and different piece of land and different objectives, but these are some general trends that I could share in the meantime.
What about mistakes? What mistakes are you seeing like builders are making, developers are making?
One, being very greedy. Greedy in a sense that, there's a fine line and balance between like the space has to be practical for the end users. Like there was a space out here in Vaughan. Like Vaughan is one of the most in demand locations across the GTA. It's one of the most highly priced, and the warehouses there are practically very new, high ceilings, right beside 400, easy access to east and west of GTA. So they're in a high demand area. So while I was going at one of these developments, this was a few years ago, I was noticing that these industrial warehouses is completely empty. And I'm like, what's going on over here? And when I dug into that particular development that these builders did, they maximized the amount of space that they could build on that piece of land. Excellent. They're looking for maximum profits. All well. The problem was that they had very limited parking spaces. And now if people were able to even buy, they couldn't get the occupancy permit from the city, because the city was like, all this parking spaces has been allocated to these other users. So with that particular greed that, it's quite simple, logical, let's just maximize the square footage on this piece of land, and, we'll just sell it and we'll get rid of it. The problem that then you anticipate is, people can't occupy it, it comes back and bites you. So you have to, so that's, parking is a very big element of it that people look for. So make sure that you don't make mistakes there. Because there's a high levels of demand, a lot of builders are making mezzanine space. This is sort of a second level within industrial space, so that they could maximize the square footage for the clients, that they can utilize it. And there's a lot of advantages to that as well. We can discuss it. However, there are certain spaces that have, almost 80-90% of the industrial space is mezzanine. So 80-90% of the space, if it's mezzanine, it's almost basically 2 floors, but it's a mezzanine level. So for an industrial user who utilizes the space for warehousing purposes and not as an office space, that becomes the mezzanine space could become a little bit of useless space. So you're cutting down your list of pool of clients. Now, not that I'm saying that's a bad build. That again depends on your objectives, depends on who you're targeting and who is going to be occupying that space. It could be a flex space. It could be a lot of these technology companies that have their, they can combine their office space along with their storage facility. All well and good. You just have to design the space according to who your target clients are. And I think that's probably the best key advice that I can give, because then in that technology space where you need the office space, then you have to make sure that there's sufficient parking, because office space parking requirements is more than industrial space parking requirements. So you should anticipate parking. Like right now we're working on some projects that are going to be coming, and we're constantly debating the parking space issue, and we're even building underground parking. We're considering rooftop parking spaces and things of that nature to help with the target clients that we have. So as an overall, don't be greedy. Don't just think one-dimensional, saying, hey, maximum space that I can build, whether through mezzanine or through horizontal square footage area, that's the best. That doesn't always work out the best. Look at your client, who's going to come and buy this, and then build the space according to their requirements. And those are some of the best developments that I've seen and the best developments that I've seen perform quite well.
Okay, thank you very much for that, Mahmoud. This has all been incredibly insightful. As you know, I'm very interested in the industrial real estate space. Anywhere where there are less speculators playing is something I'm always interested in. And there are for sure less speculators. There were a slightly less educated client base is what I find. So thank you for sharing with that. I think I want to do another episode. We should do another episode because there's so much we haven't shared about
There's
industrial
so
real
much
estate.
more to discuss, certainly.
There's so much more to discuss. And then some of the projects that you have coming online, I think we should do an episode on those uniquely and
Sure.
specifically.
Sure.
So that will be amazing. So, but thank you today for Mahmoud. I hope the viewers, listeners enjoyed it, and we will catch you in the next episode.
Perfect.
Take care, everyone.
Take care. Bye-bye.